Okay,
Great.
take it away. I've got it recording.
Awesome. So yeah, so excited to talk to you about some of the things that we've been working on this summer. The big thing is we wanted to look at decision tools for venture capital investing, and specifically a lot of the concepts that we learned about in decision tools, and see how they could be applied to maybe bring a little bit more of a quantitative focus to the venture capital space. So in terms of what we worked on this summer, we covered really 4 topics. The first was just learning a bit about the venture capital industry as a whole, how they operate and function, and some of the investing terms that are frequently used. Decision tools, we touched on that earlier, but we ended up building some Excel models with at-risk simulation tools to come up with an applied Monte Carlo simulation, and also looking at things like decision trees and decision analysis. So with the models that we built, we're able to develop a risk-weighted investment return analysis from a venture capitalist perspective of investing in a new startup. And then an additional element that we worked on was how do you quantify the startup product, the market, but how do elements like such as teamwork and collaboration, as well as the individual CEO talent factor into the investment return. So a couple of things that we ended up finding are that the venture capital world today, they largely use a lot of qualitative metrics to inform their investment process. So we'll talk a little bit more about that later, but the other thing we were able to build was take some of the previous work that developed models for business to business startups. We were able to take those methodology and then actually develop a business to consumer model. And we'll show you some of the things there, but it uses the diffusion of innovation theory by Everett Rogers. And then the other cool thing is we quantified the IRR, so takes into account the time value of money a bit more in terms of financial exit, instead of just like a simple, I'm going to make 5 times my money. That's how a lot of ventures use today. But we wanted to put some time sensitivity to it. And then the other thing is we did a comparison on the different leadership styles that work and create successful environments. And we put some sensitivity around the different types of leadership and team organizations. And so we were able to actually quantify the outcome of successful teams. So in terms of next steps, there's a lot of things that we could do. If we wanted to update our business to business models and look at some of the things that we looked at earlier this summer with market structures and how markets and industries are organized, there's going to be some new census data coming out here shortly. So I think it would be great to leverage that. And we'll talk about why that's important later. And then in terms of the business to consumer investment return modeling, there may be some more specific market share or market structures than just the diffusion of innovation theory. So you could probably look into examples of that and spend some time there. And then I think the other thing is we looked at things from like a statistical average and like standard deviation perspective to quantify the results. But you could definitely come up with some team surveys in order to really test empirically the team and culture element, as well as the individual CEO skill and traits to quantify and kind of correlate it to outcomes there. So a bit of background on the venture capital industry and startups in general. So a lot of people ask, what are venture capitalists? They are investors in startups. And I think a key point that's maybe missed on about like what startups really are, they're companies that are so young and emerging and innovative, but also risky. And they're risky to where the point where banks are actually not willing to finance them, and that's loan them money and expect to get back a return. So a lot of the traits of startup and venture capital expectations are They're going to give money in return or exchange for equity into the company. They're expecting things to be, the products and services from these startups to be highly disruptive, to really capture market share in a existing or new industry. And in terms of expectations on returns for the venture capitalists, they are looking to recoup their investment in 5 to 8 years. And so subsequently, there's actually, in terms of like what the goals for what a venture capital is, there's really only 3 main themes about what an outcome looks like. And that's the startup fails, and so they don't get any of their money back or very limited money. And then people talk about like a startup exit successfully. It could result in a public IPO. So that's a phenomena where the company will debut their shares in a publicly traded market and raise money. So that's viewed as a successful exit. And then an acquisition, that's where the startup will get acquired by an existing firm or company that wants to integrate their startup into their business. And then in terms of the different stages of like venture capital funding, there's a lot that goes on here, but I think the key themes that I would keep in mind are the cash flow of the company. And so the cash flows, especially in a time where the startup is really commercializing, they're spending a lot of money. They may not be recouping investment yet, or i.e. like selling products or getting revenue. And so that takes a lot of time, and it really is typically like an S-shaped curve. And so there's various levels of investors at each of these stages. But in the earlier stages, that's primarily where we focus the models on, because a lot of these startups in this category are pre-revenue. They don't have a lot of like data points to support that they're selling products. And so it's really interesting and also highly speculative to try and quantify startups and their potential in these earlier stages. So this is kind of just continuing on to the themes about what was covered earlier, but really, like, what is the goal of a venture capitalist? It's to invest money and then have those investments exceed and the money returned back to you exceed how much you put into it. It sounds fairly intuitive, but I think a lot of people forget that if you're investing money or you're a startup or a founder, and you get an investor, that investor wants to have their money back plus more, and that's their goal. So if you can't figure out a way to do that, then you're probably not going to appeal to an investor. So just keep that in mind. And then in terms of like what's best practice for how VCs measure this stuff, they think about it in terms, and this is a fancy term, but it's multiple on invested capital. So like MOIC. Like that goes into the concept of, okay, if you put in $1 million and the startup at exit returns back to you $10 million, then you've 10x'd your investment. And so that's just kind of like a pure play, like multiplication, doesn't take into account the time value of money. And so that's why folks use the IRR, just assuming that net present value is 0. So it's really just that rate of return discounted and the time period. So it's in a 10-year period, and it's 115% if you do that 1 in 10 million return. That's really useful because it's a good way to compare it against stock market indexes. And just for example, like the Dow Jones index or something returns like on average, I think IRR of 8% every year. And so that's really the benchmark of like what folks are comparing their returns to, because if it's higher risk and it returns less than 8%, then it's more risky and less fruitful investment compared to something like a stock exchange or an index fund. There's a lot of terms here, and the reason why I included these terms is because we use them in the models that we provided, but really the genesis of where we start with the model and assessing a startup and their opportunity in industry is to do a market sizing exercise. And that just looks at like if in their respective market, what is the total potential revenue that they could sell their product or service into. And total addressable just means it's 100% market share. And then pre-money valuation is something that's very important because that really sets the tone for what you're valuing the company at before you're doing a fundraising. So if you say that the company has a pre-money valuation of $10 million and you're raising $10 million as well, then that means that the post-money valuation is going to be $20 million. So it comes into importance because if you're giving up equity in exchange for money for your company, you want to be really reticent and aware of that stuff. And especially comes into play because of the dilution impact. And that's where if you're a startup and you're doing multiple rounds of funding and giving up even more equity shares, so that number, essentially, your denominator is increasing over time. So yeah, your denominator is increasing, and that is driving down the value of the shares in the numerator. And then equity ownership, again, that's the shares ownership percentage. And then exit multiple, we'll cover this on the next slide too, but exit multiple is one of the ways and techniques that venture capitalists and startups actually measure the valuation of a company. Usually it's a valuation based on a multiple of enterprise value and revenue. If it's an older company and more mature, it's enterprise value over EBITDA. Even if it's like pre-revenue, there's a couple of ones you could do, like daily active users, or so folks like to use this as a good way to value companies. So attached, and there's a lot of actually ways to value companies, but I included really, I think the top two or two most commonly used ones are most popular. And there's the comparables method, and that's the one that we covered earlier, in that you're comparing some sort of metric of a mature or existing firm. Usually it's something like revenue to market cap, or enterprise value to revenue, EBITDA, things like that. And so folks use that a lot. And I just want to cover the pros and cons of doing such a thing, because that's really where you see the genesis of using decision analysis to come up with this and to value these companies is useful, because we can quantify a lot more things that some of the downsides ignore. So yeah, in terms of the downside of using the comparables method, it's great for companies where there's like benchmarks that are similar, but if there's no similar companies, then it's kind of a crapshoot. You have to really stretch or guess, or maybe even compare companies that aren't very good. And so it's kind of like garbage in, garbage out there. And then I think the other thing is you're looking at revenue or some sort of lagging style indicator that's not really a one-to-one, and are not actually comparing some of the more qualitative elements like team talent or product reception, as well as just how risky that actual market is. And then another final thing that shouldn't be neglected in comparables is that it's really looking at things that are current in industry. Like a market cap is something that usually changes every day, and market caps or multiples or comparables, they can certainly change over time. And so you really only have a historical lens of the comparables, and forward-looking ones is even more subjective to be able to try and estimate. And then the second popular technique is called discounted cash flow. That's something that we learned in the finance class with Dr. Rao. But so that's the idea of projecting a company and their financials, and then looking at how much cash flow the business is generating. And so then you're really just saying the intrinsic value of a company is based on its present day and future estimated cash flows. And then you can discount that all back. It's really solid for existing businesses that, again, have like predictable cash flows. Where it becomes difficult is back to that like S curve. If you don't have revenue, or you're a pre-revenue startup, it's as good as anybody's guess on how to actually model that. And so there's that piece in terms of the actual revenues and costs associated with that, and cash flows can be inaccurate. And then again, like we're still neglecting team talent, product uniqueness. So a lot of times what happens, especially in discounted cash flow, people will just kind of knee jerk raise the discount rate as a function of risk. And it's kind of just like a generally accepted thing, like, oh, we're going to make our discount rate 30 or 40% based on the stage of the company. And it's just not very rigorous at all. And so we think that the decision tools can do a little bit better in terms of quantifying that. So yeah, what exactly do we do? In its simplest form, I tried to write it out this way just to help folks visualize what we do. But we take all of the inputs of a company and their potential, as well as a deal that we would structure in a seed style deal. And so we look at that and load it into the model. And then we also have things like, what does the future, how big is the market? How will the market share look in the future? So we'll talk about one of the techniques we used for the B2C. And then we also think about like how long till the company is going to exit, and how many years will that take? And then in terms of each of the stages of the company's progression and growth, we have 4-factor criteria to actually rate the company and how well they're capable of graduating into that new criteria. And so because it's Monte Carlo simulation and we can use sensitivity analysis, we have low base case and high end projections for pretty much every single input. And why this is important is because when we do the Monte Carlo simulation, you can simulate the randomness of the range of outcomes in order to really produce like a meaningful range. And so we'll see what that looks like. And then in terms of model simulation techniques, we talked about this, but decision trees, so that's the idea of just modeling all the potential outcomes of something, including failure and success. And then Monte Carlo simulation. And then tornado graphs are really cool because you can see the different, how the inputs actually have the greatest change on the model outputs. And then because we're doing this in at risk, it's fun because you can model 3 or 4 different outputs. So we have the probability weighted startups revenue. We have the probability weighted market revenue potential. We also have the probability weighted multiple on invested capital, the IRR, and then the exit year. Exit year, back to that example, means that we can actually establish a range of years between 5, 8, and then 10 years and load that into the model and then see how it affects the IRR. Okay, so you're probably wondering how the heck do we even come up with this? But we started with the idea of a decision tree, and it goes back to that concept of if you can just categorize a startup into 3 distinct phases. And so this is one suited for business to consumer startups, but the way that it works is if you think of a startup's life cycle or stages, they have to first come up with a proof of concept or some sort of prototype. And the question you have to ask yourself is, can they successfully do that? So we have rating criteria for them to be able to do that. And most people that look at startups and investors, when they're meeting with startup teams, this success stage is actually, I would say, decently high compared to like the rest of the market. And that's because you're maybe dealing with like a 2nd or 3rd time entrepreneur, things of that nature. So, or a very skilled team. So you have like relatively high confidence in this. But for whatever reason, let's say things don't work out. And so there is a chance of failure. So that's really the first stage. The second one is like validating product market fit. And this one's pretty difficult track because like you could have a prototype, but that doesn't mean customers would be willing to pay for it. Or if it's a case that it's not something that's paid for, you have to have users use it. And so we are able to rate criteria as well on the product team, financials for this category in this phase. And then mass market, that's really like hitting mainstream. And there's a few distinct outcomes of mass market that we have grouped into. But the idea is that, and you'll see in the diffusion of innovation model, that there's really distinct phases. And the idea is, can you hit, well, will you only become a very niche person and let's say have a very small customer base that uses it? Or can you break out into the mass market and appeal to niche people as well as late adopters and then even like laggard adopters? And so at each of these phases of the decision tree, the probabilities are just multiplied together. And so by the time you finally get up to 0.3% probability, you've multiplied each of these 4 independent probabilities together. And so we carry that through with the whole model. And you can see that there's a very high percent chance of failure because you've got, let's see, 80, you've got almost 94% chance of failure. But I think this does a great job because it, number one, not a lot of venture capitalists use this. And they don't think about how well a startup's ability with risk involved is, can they actually capture an entire market and revenues? And so this is pretty much the core insight behind a lot of the model here. And then the Monte Carlo piece is a great way to put sensitivity around this insight. And then so I hinted that we're really measuring the startup's ability to capture revenue. And so when you do that, and we have the, how do you kind of think about market share, right? And market share in terms of business to consumer is extremely difficult because you may have just a group of consumers that will want to buy something, and it's not like in business to business where maybe there's only 5 customers or a certain set of people. Business to consumer, you could have millions or hundreds of millions of customers. And so this was pretty cool because we were able to take one of the concepts and theories from Everett Roger, and he talks about the diffusion of innovation in terms of user adoption. And so the gist of it is you've got a percentage of a population that is, let's say, an innovator, early innovator. So they make up only 2.5%. And then let's say that actually succeeds and goes well, and you break out in terms of your startup adoption to early adopters. So that's a larger segment of the population. So then we've got up to 16% in terms of cumulative folks using it. And so we just scale that up in terms of all the way up to the very end of the chain. So laggards, these people would be the very last end users. And so, yeah, that in terms of that, once we get to laggard adoption, it's full saturation of 100%. And so we carry this theme about cumulative market penetration all the way over to what the initial TAM input is. And so you can see if we do hit early majority of the market, so that's exactly at 50%. And so that's 50% of the TAM. And then it just kind of scales up. So 100% of the TAM would be the 11 or almost 12 billion. So yeah, that's really how it works. As you can see, the startup does get punished if they're only in the niche market space because there's just not a lot of revenue potential there. Okay, so the next slide, this gets into the nuts and bolts of the Monte Carlo simulation. It's really quite fun. We took just a regular archetype like business to consumer startup and then looked at their total available market. I think we plugged in like 14 billion or so. And then roughly like at each of the 3 phases, we started with high rate of success, so like almost 90%. And then I think 80% for product market fit, and then 70, I believe, or maybe even less for success of commercialization. And so when you do that, you get a distribution of ranges here. And so this gets into what we were talking about. So for this particular startup in their market, in terms of the multiple on invested capital, you can see that there's almost a 65% chance that they have greater than 2x return for this particular investor. And then this is also cool because we plugged in the IRR, and I don't remember the ranges of years to exit, but I think we set the minimum at 3 and then the maximum at 10 years, so a bit outside of that 5 to 8 year range. And you can see that in terms of like beating the market average, the startup has particularly a 76.2% chance of doing so. And I think this is really cool because there's a lot of folks that just say like, oh, I know I've got a winner. This company's going to really do it all. But we can actually see, okay, well, what happens if they do it all? And then at best, we're looking in an infinite return of like 10x your money at the very highest end, or 8 to 10x. And then on the IRR chance, the maximum IRR we could get is potentially 80%. So it really kind of grounds you, I think, a bit more in terms of the unbridled enthusiasm of investor. And so it's great to be able to see the distribution of different outcomes here. And then this one's the tornado chart. And I think these are great for investors because this shows like where's the most sensitivity around exit. And if I do want to maximize my money, like what should I watch most closely? And the sales multiple intuitively makes a lot of sense because if something is worth 5 times sales in terms of valuation, then you really don't want that to decrease at all. And because, yeah, there's that. And then the sweet spot TAM, another very important one. That's really how much of the addressable TAM that the startup we think can capture. So most of these models take into account to say that there is the total available market, but what if the startup only captures like 50% of the TAM or 30? And so we have those different ranges of outcomes there. And then dilution, again, big theme we touched on earlier. But if the share prices become diluted over time, they can significantly affect their multiple on invested capital. So it's really cool just to see the different traits that folks should monitor along with their investment. And then I think it's also fun because you guys are going to do this in finance, but you'll also see like how different parts of a company or elements of a company will factor into the valuation. So the next piece is going into that quantifying human synergy idea. And there's really good research actually out there by this University of Chicago professor and a few other folks, but they actually studied the traits of top CEOs of both private equity firms and startups. And they did this because a lot of folks in industry administer what's called a GH SMART test. And so candidates have to take this test and they're evaluated and ranked. So what does it mean for us? Well, it's actually great because we have a mean and there's a population and sample size of folks that are being tested and benchmarked. And then we also get a standard deviation out of that. But I think the most important things are like what in terms of candidate traits do CEOs of startups stick out on. And when I say stick out, I mean like statistically significant. So that's p-value of less than 0.05. And the traits that startup CEOs rank better than anyone on where they were able and willing to remove employees that are underperforming. They stay true and have a stronger strategic vision. They're more creative, proactive, and work with teams. And so we'll see how we can factor this into the model in a few slides, but it is interesting to point out, I think, traits of a successful CEO for a startup and what to be looking for. So then the next one we're going to look at is human synergistics. There's some cool research out there from this group of folks that talk about organizational culture. And they have a few studies published about the correlation as well as the uh, expected results or output of higher or better culture teams. And so I think the key thing to look at is there's three different types of cultures on the left-hand side. And the one that is most supportive of a better performing organization is constructive culture. And in terms of like the four elements that they characterize as a constructive culture, they're listed above. And so it's really emphasizing things like customer focus, trusting others, um, being able to have the autonomy to do tasks, and an environment where people are encouraged to work together and come up with good results. And then, so they compared the output both individually and group, as well as company outcomes across the three like archetypes. So cultures that maybe aren't as constructive or collaborative. And yeah, so we were able to, with this, to factor these four factors into the model to come up with a range of outcomes for the startup success. So this one is pretty cool, and this hasn't been done before, so I was happy with this. So I think what we did was, because we had the research that had a established mean ranking for the traits as well as the standard deviation, we loaded in the 5 most important traits and factors that I touched on earlier about the CEOs into the model. And we gave that and assigned it at the assessment piece where the startup needs to prove product market fit or cross the chasm, as it's kind of known. And then Jeffrey Moore, Guerrilla Games study. But what does that actually mean? It's really, you're ranking and rating the CEO's ability to get things done and stay true to those traits. And so what we did was we came up with a test that compares the CEO traits in terms of their top percentiles. So that 2 standard deviations above their mean ranking would put them in the 95th percentile. And we did the same exact thing with the team synergy part. So that was the 4 constructive factors, and we assigned them a mean of 2.5. So that's just pure average out of 5. And then because the CEO study was also out of 5, and then we gave them a standard deviation of 1. And so what does that mean? Practically speaking, a 4.5 out of 5 would be a 2 standard deviation above the mean. So you're looking at a 95th percentile team and then a 95th percentile CEO. And so that's what this diagram is showing down here. And so to really test this out, I just compared the results of if you do like a standard kind of 4x4, what does this 1 standard deviation CEO with a 2 standard deviation team look like? And then let's look at the results in terms of their multiple on invested capital and then their IRR. And so unsurprisingly, what you find is that there's very close correlation between CEOs and teams that are performing in the second standard deviation, so like 95th percentile. They're having almost double the output in terms of results here. So 2x in terms of multiple on invested capital, and then almost 9% better in the IRR. And so yeah, this part was actually really fun for me because I just think it goes to show we actually have the CEO being on the second wave of the startup, and then the team assessment and culture assessment being in the very first phase of the startup life cycle, to really illustrate the importance of, you may not need a world-class CEO from the beginning, but it's more important to have the team. And we confirm this with empirical interviews with investors. And yeah, so when you plug that all in, you can really see the importance of the having both the team and the CEO being top performers and bringing a top culture. So in conclusion, so venture capital investing is really a qualitative field as we touched on at the beginning, a lot of folks are still doing the comparable multiple discounted cash flow valuation method. And then they have just a checklist of tough questions or things that they're looking for and traits that are largely qualitative in nature. And so this is fun for us because what we've done here is incorporate market risk, product risk, team risk, and wrap that up into a very discernible number and shown like a range of outcomes. So folks can see that, hey, I have, instead of saying I have high confidence that we're going to get a 5x return out of this company because I'm a believer, we can now say, based on the range of outcomes, we think that there's like a 70% chance that we can get over 2x our money. And so the conversation becomes much more informed, especially about what you're getting into and maybe some of the deficiencies about the startup itself. And what was fun too is that we were able to scale the model from some of the earlier examples in B2B to B2C. And so I think that these types of models can be recrafted or configured for anything as wild out there as maybe cryptocurrency is. I don't know. Yeah, last insight was really that top teams and CEOs matter, and that's something that can be measured. So it is important to have a great team and culture, as well as a CEO that probably has a lot of the traits that were highly correlated. In terms of kind of next steps and things, I think we covered most of these already, but I do think it would be fun to do like a team survey assessment of the culture, especially at the early stage, because some teams especially are like, oh, we just have like a great chemistry, or there's a great working relationship or vibe. So it would be fun to actually study that empirically and kind of confirm that with the constructive culture research. So yeah, I think that's really the presentation. Thank you to all the folks that helped out. Yeah, everyone from the McCormick School to Kellogg was very helpful, as well as some of the folks at ULA Ventures that are actually using these techniques to invest in seed startups as well. Cool.